Good day, everyone. My name is Vinay Nadkarni of ClearBridge Investments, and I'm happy to be hosting this call with my teammate Brian Lund, co-portfolio manager of the ClearBridge Small Cap Strategy. Brian has 18 years of industry experience and 14 years with our firm and has been dedicated to this strategy now for almost 6 years. As a reminder, ClearBridge is an authentic active manager where we believe portfolios can combine concentration, valuation, and risk management to create a client solution that is significantly different than market-based passive and factor-based solutions. We at ClearBridge truly believe this is both a differentiated and complementary strategy to use as a tool for portfolio construction. As a quick introduction to the attributes of the strategy, it's a high active share, moderate tracking error strategy where through thoughtful portfolio construction, most of the risk budget is idiosyncratic stock-specific risk versus factor risk. To give some data points around that, the active share versus the Russell 2000 is 95% at the end of February. Tracking error has been in the 3.5% to 5.5% range over the time of the strategy, and the strategy has consistently had 85% of its risk budget come from stock selection due to its awareness of its tilts on a quality, valuation, balance sheet, and momentum basis relative to its underlying benchmark. Our format will be moderated question and answer. We took questions that we've received in client meetings over the last few weeks and months about the markets and our investment process and philosophy that we hope should take about 25 to 30 minutes. So, Brian, thanks for joining. Here's where I thought we'd start. I always think when we talk about investment philosophy, it's part about what we're trying to achieve and part of what you personally bring to the table. So, Peter Kaufman of Glenair has on his checklist of the attributes of a good money manager as someone who has, quote unquote, deep fluency in whatever they say they are going to do on behalf of their client. Could you maybe go through what you, Albert, and Eric are trying to achieve for clients and maybe what your personal experiences that have shaped you most as an investor have been?
Sure. What we're trying to achieve is to create a portfolio that has a lot of balance that, as you say, is not trying to make a bet on factors or industries or forecasts that we have because we don't have a lot of confidence that we can bet those things consistently over time. What we believe is that we can apply our investment process to probabilistically beat the market through better stock selection. And where that comes from is we have a great respect for the market and the market's pricing mechanism. We start every investment by examining what it is that the market expects from the stock. That is, what future returns on incremental invested capital, what level of capital investment, and for what duration that incremental level of invested capital return is going to be earned. So in a very quantitative way, in a discounted cash flow modeling way, what does the market expect? And then we try to figure out what, based on our competitive strategy work, we can think of as a variant perception that makes us believe that there's a good chance, a better than average chance that we can outperform. This way we hope to exploit some of the behavioral errors that arise in the market where stocks swing too far one way or another based on sort of a diversity breakdown in thought in the market, and at the same time try to protect ourselves from our own anchors and behavioral errors that we know we have in us through strict adherence to a process.
So I know you had a very atypical background to start.
Yes.
And you started at the Motley Fool.
Yes.
And in Morningstar.
Mm-hmm.
Being a writer, right, in essence, how did that kind of lead you to kind of think more creatively about investments, and how has that kind of formed and I remember you talking to me about getting exposed to Michael Mauboussin during that time period.
Yes.
Just kind of how that's kind of shaped you personally and thinking about executing on that mandate.
Yeah, I started not in economics and finance classes, but with my own research into what good investing was, and that meant a lot of Buffett, Peter Lynch, and, as you say, Michael Mauboussin, whom I started to read at the Motley Fool, where I was in 2000. The Motley Fool was, at the time, very interested in education of investors, and it was not so much about, there was a personal finance angle, but there was also a how to research stocks angle. So really I came to the business with my North Star being Buffett and that other kinds of investment thought. When I went to Morningstar, I received a fantastic education in discounted cash flow modeling from my director of research, Pat Dorsey, who based his entire valuation process on the McKinsey model, very strict McKinsey model, and he had a very broad range of analysts, so we had to think about how to build into that model operating lease capitalization, pension valuation, all kinds of different valuation anomalies and idiosyncrasies. So I've got a very good education in actual discounted cash flow for stock valuation modeling, not anything out of a textbook, but always live application. From there, I got to work at Legg Mason with Michael Mauboussin, whom I had been reading before, and got very much into the expectation side of investing and how to determine a falsifiable variant perception based on why a company would earn a better return on invested capital or have more capital to invest. Got us thinking in a very probabilistic way also, not making forecasts, but having the humility to believe that lots of different things could happen than what we think is going to happen, and to make sure that we're positioning the portfolio to take account of those various possibilities. And then finally, I got a fantastic education in the financial crisis working at Legg Mason with on the funds of Bill Miller, where I learned a great deal about the risks and dangers of very high sector exposure and very high intersector correlations. That made us really tilt the portfolio away from those kinds of bets, because while it's great when it works, it's really, really terrible when it doesn't. We want to create a portfolio that can work in both the good markets and the bad markets, and that protects investor capital.
That's super. So let's walk through what I think in doing meetings with you people have really kind of gravitated to as differentiated parts of your process and how the team implements them. I'm thinking of a meeting you and I did with a consultant in Chicago in December. So first is really how efficiently the team can go through a lot of stocks by unpacking embedded expectations using a reverse DCF. And the second is really how you model companies that are potential candidates for the portfolio and how you think about that idea of persistency of superior returns on invested capital, or how long they can earn those incremental rents. So can you maybe walk through these two parts and maybe use a recent purchase? The one I'm thinking of is a more controversial name like Bank of the Ozarks, and demonstrate how that process worked in practicality.
Sure. So we start with, as I say, a backward discounted cash flow model that tells us what the expectations for future returns and investment rates is for a company. It's a pretty standard discounted cash flow model. We take the analyst estimates, plug it into a very skinny down forecasting model, use CAPM for a discount rate, and see what is expected, basically how long the company will earn returns above their cost of capital, and how high those returns need to be in order to justify the stock price. So, the stock price is the piece of information that we have about what the market's expectation is, and we simply want to decompose that into a discounted cash flow model that equals that stock price. Obviously, there are a few different variables there. Maybe they can invest more at a lower rate of return, but still higher than their cost of capital and over a longer period of time. But what we want is to get a basic sense of whether we think, based on our industry work, we're going to be in the ballpark and have a good reason to believe that the stock is undervalued, whether it's because we think they can earn higher returns or they can invest longer, or the returns will be more persistent. With a company like Bank OZK, as they are now known, this is a bank that had excellent lending, excellent loss rates for 20 years, 20 plus years. Had a very unique model that allowed it to generate higher loan yields with a lower cost of funding than most other banks, and a remarkably low efficiency ratio, since it had so few branches. So they were earning high NIMs, that is net interest margins, with low efficiency ratio, meaning their operating expenses were low. It was a highly profitable bank. Very high returns on equity. They had two bad credit experiences in the third quarter of last year, and on that basis, the stock fell over the course of 3 months by 50% to tangible book value. And this is a bank that earns returns in the 15-16% with a cost of equity in the 8 or 9% range, so that a justified tangible book value for them is at least 1.6, 1.7, and this was trading at 1. It was a remarkable 1 times book, yeah. So this was a remarkable opportunity for us to get a very high quality lender at a very good price. Now, obviously, the market's question was whether that book was impaired based on the outcomes that they'd had in their 2 loans. But the bank demonstrated very well that those loans both came out of a very old vintage and had been under watch for some time, and that since then their lending had changed to a much lower loan-to-value ratio level of lending in the 40 to 50% range. So when your loan-to-value is 40, 50% versus 80%, significantly less likely to realize a loss in that when you've got a first lien position, which Bank of the Ozarks does. So while those were bad experiences, we believe that they were anomalies in this book and that we're not going to see very many more of those. And we were being given the opportunity to have more of those because the valuation was so very, very low. But we don't think we're going to see them. And sure enough, in the next quarter, we didn't see them and the stock popped.
So, for the listeners to frame that out, the 80% range that you're talking about, is that a peer group average normally, or is that their historical average? So when you said a 40 to 50% versus kind of an 80% range?
The vast majority of Bank of the Ozarks loans are at 40 to 50%. Peers differ in where they will do their lending. Some do it at 60. Yep. This 40 to 50 is actually quite low. But these were old loans that had migrated up to the 80% loan-to-value ratio.
Yep.
The bank has one other loan that is in that high loan-to-value ratio bucket, and they're aware of it. They're very open about it. And again, we could lose 100% of that loan and be totally fine.
Great. So let's move from kind of process to thinking maybe a little bit more about just the market, and everybody kind of asks us about the market environment. So your recent commentaries, I think, have been very thoughtful, and they've talked about both the IPO market and how many of the recent IPOs are money-losing companies. Not that you shy away from money-losing companies necessarily,
right?
And you've also talked about recently about public versus kind of private valuations. Given many of our institutional investors think of small caps alongside venture capital and private equity potentially in their asset allocation framework, can you talk about the discussions the team is having in these areas, specifically around how you think about what's going on with the IPO market or what's going on in private markets?
Right. Well, we try not to forecast anything, so we don't think deterministically about any of this. We simply try to observe what's going on in the greater market and think about how it might impact our investments. We have seen a lot of IPOs come out with negative earnings. That can be okay, as you say. We don't shy away from them. We have plenty of companies that have negative earnings based on investing that they're doing in projects that are going to be highly value creative in the future, and we're fine with that. We want to be able to invest anywhere that we can. My concern is that on average, if a greater percentage of the market is becoming money-losing, that we may be running a valuation risk that, should we get a downturn, could cause a strong negative market swing. In addition to that, the number of companies in the public market is shrinking, and is shrinking dramatically. It has been cut in half in the last 20 years. And now here we are with a little over 3,000 public companies. When we are investing against the Russell 2000, we're talking now about, the companies at the bottom of that market having market caps in the $60 million range, like just tiny uninvestable companies. The reason that this is happening, I speculate, is that there is a huge pool of private capital now that has bought up companies and is trading them among each other. There's also a huge number of venture capital funds that are funding companies that are likely still money-losing in most cases, but are still private. Now, that's great when liquidity is good and the market's strong.
Right.
At the end of last year, we saw the beginning of a little bit of panic. It has largely reversed itself in the beginning of 2019, but that sort of panic may lead to not just the market dropping sharply in public, but the private market, where valuations don't change that quickly because there's not a daily quotation for every investment. That market may become significantly more illiquid, where companies are not able to come public with either no earnings for the venture capitals or a high level of debt for the private equity. In addition to that, we have a lot of private debt funds starting up that are now competing with our banks for deals on, CRE loans, commercial real estate loans, and other kinds of lending, which again is fine. But when we come to a bad time, this is not a great equation. And at the same time as all these companies are piling up in the private market with a lot of debt and low earnings, there is more dry powder piled up now. There's twice as much dry powder piled up now as there was in 2011 when the market for private equity was much more attractive. So obviously we don't invest in private equity, so our conclusion isn't to stay away from those, but our conclusion is that we could see a extremely volatile market where a lot of assets are coming to market at fire sale prices because of the illiquidity in the private markets.
That's a really good kind of explanation of what's going on within that. I was just at an institutional conference yesterday, and as you said, all the interest is on the private side, whether it's private equity, whether it's private credit, et cetera, frankly, private real estate. But I think people on the investment side were much more cogent about the risks, I think, on the 1 year basis.
Yeah, and interestingly, the returns in those funds have gotten worse, and the liquidity that normally in the past would have provided the premium returns, it has become less.
Yeah.
At least in a private market, in a public market exit. So unless you're going to be able to sell to other private equity funds, just trading horses among one another and have valuations stay up that way, I find it difficult to understand why people believe they're going to earn good returns in private equity or venture capital.
Yeah. So we worked together kind of as teammates. As you said, you came over from Legg Mason Capital Management in 2013 as teammates for about 6 years. So, But within your team, I think one of your real strengths among the three of you is you're philosophically aligned, but you're also very different. Yep. Right? And I think the idea of having cognitive diversity, and I think of your strength as being able to analyze and really think through businesses that have more hair on them at potential downside risk relative to large outsized kind of upside. Mm-hmm. So I'm going to walk through a couple sectors because you just said something that you're not forecasters, but yet you have meaningful exposure in areas like financials and in areas like energy, where autocorrelation might be pretty high, or people think of them as, don't you have to have a view of forecasting interest rates, or don't you have to have a view of forecasting supply and demand for oil prices? So how do you think of your framework applying to those kind of more cyclical, kind of autocorrelated industries?
Right. Well, as far as the sector exposure goes, we think of ourselves, again, we don't want to try to make any bets, so we have to have a view on interest rates in order to deviate from the benchmark. Right. So if we're not going to own the same weight in banks and REITs as the market, then we need to have a reason why. Now, sometimes we can't have that reason when the valuations in the sector are ridiculously high. So we had that situation with REITs not too long ago when we had it with regional banks in the last 2 years. We were underweight banks, but where it is 8 or 9% of the index, we wanted to be, if we're going to be underweight, 6 or 7%. And we're going to choose the best banks that we can. Fortunately, there's a large pool to choose from. So we can find differentiated banks that we have a variant perception on and still afford ourselves interest rate exposure. Since that time, since last year, middle of the year, bank valuations have come down sharply. They did in the fourth quarter, and many have not regained their position. So we've been able to find more attractive banks to get more market weight. That's where we want to be, and we want to have differentiated stocks, because as I said at the beginning, what we want is for our investment selection process to be the thing that shows through, not our macro factor risks. In energy, it's much the same thing. We want to be in the best companies that we can without taking a big bet on oil one way or the other, although we will use the prices to fade one way or the other. Right. If the price is what we consider to be high, we'll probably be a little underweight. Not too underweight, still exposure, but underweight. If the price is what we consider to be low, we might be a little overweight. And that's based on what we view as the marginal supplier's cost in the market. Right now, that's North American onshore. If the price goes up, then it becomes offshore. So that's on those sectors.
Yeah.
In a sector like biotech, it's a very different thing. There's no being market weight biotech. You're either owning every stock or you own single stocks that are going to do well because the returns are going to be completely idiosyncratic across the sector.
Right. You told me this then when we did that meeting. That You said, look, owning a basket of 6 biotechs doesn't really do you anything. You haven't really diversified the idiosyncratic risk.
You're right.
You could be wrong on all 6 or you could be right on all 6.
Exactly. It has offered you no diversification. Well, it has given you diversification, but it was not giving you protection against the market if it soars. Because if it soars, biotech soars, it's probably going to be 10 stocks that really drive out of the 300 biotech stocks. So you got to get one of those right if you're going to do well. So what we try to do is get one of those right, or at least get right one that we think has a reason to compound. Our exposure is almost always with companies that have a drug in the market or are very close to getting a drug in the market with very, very low safety signals, very non-existent, basically, safety risk, so that the chance of approval is high.
Is there any commonality in, as you said, you're trying to have diversity, so like in areas like financials or in energy, is there maybe common threads of things that you're finding attractive right now, like if you said like kind of North American onshore, those type of things, how are you finding differentiated business models within, right? Because you're not trying to buy the market, as you said, you're trying to find good, unique assets within it. Is there a set of attributes that you're finding more undervalued? Is it one of those economic variables that you're trying to unpack that you feel like right now is most discounted amongst your kind of energy companies? In
energy, yes. There is a difference between the plays that a company is in. If you're in the Permian, you get a certain level of valuation. If you're in the Niobrara in Colorado, you get a different level of valuation. If you're a pressure pumper versus a driller, you'll get a different valuation. And that may be cyclical. And I'd say it goes in waves. Sometimes the market wants pressure pumpers for high completion rates. Sometimes it wants drillers. The stocks go up and down, and we try to invest accordingly. But we do realize that there are reasons why the market loves one or other of those plays at any given moment. And so we like to diversify as much as we can, even within those segments. That's why, even though it's a low level of exposure to the benchmark, we may own a lot of stocks in energy because we want low exposures to a number of different plays, service companies, service suppliers, et cetera.
And that contrasts a little bit because you and I talked about with banks, to try to find that, you might have chunkier positions. You have a couple that have been in the top 10 or top 15
even top 5.
Yeah, Cadence, for example, is in the top, I think, 5 right now.
Yes, and First Interstate Bank was there previously. Yes, with banks, we are willing to be more chunky because they are much more the same. There are some cyclical changes that go on. There are waves. If energy lending looks bad, in fact, energy banks usually will trade at a discount.
I think that's when you bought Legacy Texas.
That's when we bought Legacy Texas. We did very well on that. But there too, we want some geographic diversity. We've got a bank in the Northwest. We've got a couple in the Northeast. We've got 2 in the Southeast. We've got 1 in the Midwest now. So we want to cover the map as best we can so that we're not taking too many bets. There are a couple of niche lending areas that banks may occupy. We have one bank, Tri-State, that lends to private investors. So they are holding the security book for an investor, and the investor borrows against that security book to buy a second home or something like that. That is an almost riskless bet because the securities that the bank holds are the securitization for the loan. So the loan yields aren't big, but the loss content is 0.0, and it doesn't count against their capital. So they can leverage more than other banks with this low-risk lending. That's a very unique niche, and they dominate it. Bank OZK has a big marine and RV lending franchise, which is a similar kind of thing. It's rich people who want a short loan at a low LTV. So 40%.
People want RVs?
People do want RVs still, not in New York City, but elsewhere in the country. And then they have a big construction and development book, which is different from most other banks. So there are little niches here and there that can define a bank as somewhat different, but, low cost deposit base, really strong, commercial real estate franchise. But we try to take all that into account when we're diversifying our exposures.
So you said something in healthcare, which is you're trying to find some home runs. So you wrote about this in the third quarter, and it's moved strongly this year too, which is Amarin. So you found one, but it also is probably a good test of kind of testing your own behavioral impulses, because I think you bought it in 2015, and for 3 years people were kind of saying, hey, what the heck's going on, right? It was, I think, a $3 stock before it had the massive kind of data news. And so maybe walk through now, and I remember I was down with you and the three of you guys in Baltimore in early October, and you guys were debating, should we even sell a share at this point?
Yeah.
And from a risk management standpoint, you guys said, oh, look, is it one of our most confident picks even from here? Yes, but how do we size that? So now the stock's had another nice move. How do you think of the stock, or how do you think about position sizing, or kind of the case for Amarin from here?
Yeah, so for a number of years, healthcare was a real sore spot for us. We underperformed for 4 consecutive quarters in 2017 to early 18. And healthcare was by far the biggest reason, because the things we didn't own did well, and the things we owned did terribly, including Amarin, which was down 35% in last year before it came out with its data. So we bought it in 2015, as you say. We bought it at $1.80 a share. This is a company that makes a refined fish oil medication that was used for high triglycerides. So it was approved for triglycerides over 500. We'll leave out too much of the science here, but over 500. There was another drug in the market that also was approved in that area, had become a $1.5 billion drug when it had become generic. So Amarin was competing against a generic in that category. They price at the level of the generic, so it's a relatively cheap drug. And yet their results were significantly better than the other fish oil, because what they do is they take all of the DHA out of the fish oil. It's a pure EPA drug. And if you see another fish oil claiming to be pure EPA, if you look closely, you will see it is not pure EPA. And it turns out that DHA may be implicated in raising bad cholesterol, LDL cholesterol. So it's a more effective drug at a generic price point in a market that existed. It's been approved since 2012. So on that basis alone, we thought that Amarin was worth more than it was trading for. We thought it was worth in the area of $5 a share, which was big from $1.80 where we bought it. It was doing this large outcome study to determine what the cardiovascular outcomes were for people who took its drug for a long period of time, and that was taking 8 years. So in the meantime, the stock languished, and nobody cared about it. Every time I would see them at investor conferences, people would be like, I think it's about 50-50, it'll work or it won't work. But there was plenty of science previously that showed that pure EPA could have positive outcomes for cardiovascular events. So we thought there was a good reason to think there was a better than 50% chance it would work for that, which would just be gravy on top of the current market.
Yep.
Well, in September, they announced that, in fact, on top of LDL that was well controlled with statins, so people on Lipitor, low LDL, they got a 25% improvement in major cardiovascular events in the population that they studied, who were a population that was at risk for cardiovascular events. 25% reduction is about what statins offer, and statins are a drug that 50 million people in America take. If 50 million people took this drug, we would be talking about a $25 billion drug.
Right, because as you said, it's an approved drug with a price point at $500.
It's an approved drug with a price point with a long safety record that shows no safety outcome. It's a fish oil. It's got the fish oil safety profile. So this is a massive opportunity, massive. Because statins do have side effects that are negative, it really could apply to a population that goes even beyond those taking statins. That 50 million, too, is just in the United States, and Amarin holds exclusive rights in the United States and in Europe. So this is a monumental blockbuster opportunity that has patent protection to 2029. We believe there are those who may argue about that, but we think they're differentiated to 2029. They're not the same as over-the-counter fish oil, which is a thing that other people claim as a negative. In fact, for most people, over-the-counter fish oil would be more expensive than getting the prescription Vasipa that Amarin sells. So this is a massive opportunity. They're now putting together their filing to the FDA to expand their label to all triglyceride levels. Right now, they're only over 500, which is a very high triglyceride level. Only applies to 2-3 million people. So right now, we think it is trading as though it built the sales force itself, and it gets to a peak prescription level of about 4 million people. That, we believe, is ridiculously low. And we think even if they don't get bought, they're worth significantly more than they're trading for, and we think they're very likely to get bought. So, there are a couple of things that could happen that are negative. The FDA could disagree with its data for some reason, but these are all very low probability events.
Yeah.
So we're very bullish. In fact, even if it became generic immediately, it would be difficult for competition to make money producing at its price point.
Because you said they've secured a lot of sourcing, too, for the
manufacturing. They've secured a lot of sourcing for the manufacturing, but again, even with the manufacturing, somebody would have to build up the manufacturing and then go try to get a market where Amarin already has scale at a low price point. So this is one of the safest healthcare stocks that we own, and that's why it's 4% of the portfolio. It creates diversity for us because it behaves like nothing else. We think it's deeply undervalued still, and it's safe. In our opinion, relative to the others, it is safe. So, I think it has no reason not to be our biggest position. We have managed it to stay at or around 4%. Simply because we don't want to increase the volatility of our returns that much. It's already added to our tracking error, which we're not happy about, but it's been the good kind of addition.
It is a good tracking error. And so this is a great stock, I always think, to talk about because, as you said, I always think one of the behavioral things that you exploit is people think too narrowly in a range of outcomes, right? Yeah. So the stock's up 600% from that time, and I think most people would be like, you have to sell. Your behavioral impulse is, everything's been extracted, and you just walk through you have to think about a wide range of outcomes, especially in small cap stocks, and probably especially in biotech stocks. So why don't we close there? We want to thank everybody for listening. Hope you enjoyed the content. If you have interest or follow-ups, please contact your ClearBridge sales representative, and we'd be happy to get you more information on the ClearBridge small cap strategy.